Hey there, Singaporean investors. Tired of sifting through endless news trying to figure out what truly matters for your SGX portfolio? Or maybe you're wondering how today's market moves impact your investments. Welcome to the Investing Iguana's daily SGX Market Digest for July 11th, 2025. I'm Iggy, and in the next few minutes, I'm cutting through the noise to bring you the critical updates, hidden insights, and my unique take on exactly what happened on the SGX today and what it means for your money. No jargon, just clear, actionable intelligence you won't find anywhere else. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We've crossed the 1 million mark for reads, and with over 900 videos and 500,000 watch hours, content is literally all I do. I also focus on regional and global economic trends, giving you that broader context. So let's dive into today's most important SGX movements. You don't want to miss what's impacting your portfolio right now. The Straits Times Index showed mixed signals today, with the benchmark hovering around the 4,075 level. We're seeing some interesting sector rotation happening, particularly in telecommunications and healthcare, which tells us investors are being selective about where they put their money right now. Trading volumes were moderate at around 1.2 billion shares, suggesting cautious optimism rather than panic or euphoria. Now let's zoom in on Singtel, Singapore's telecommunications giant and a major player in the regional connectivity space. The big news here is their technology arm NCS announcing a massive 130 million Singapore dollar investment over 3 years to boost AI development across Asia Pacific. This isn't just throwing money at the latest tech trend. They're building an entire AI suite called Sunshine AI, forming 6 major tech partnerships and training their workforce. With over 1,000 professionals already certified on major cloud platforms like AWS, Google, Microsoft, and NVIDIA, they're clearly serious about this pivot. Singtel shares closed 1.3% higher at $4.01 on Thursday, before this AI announcement even hit the wires. Their current market cap sits at around 63.74 billion Singapore dollars, with a price-to-earnings ratio of 25.95. The dividend yield remains attractive at 4.2%, making it a solid choice for income-focused investors. What's fascinating here is how this AI investment positions Singtel not just as a telco, but as a regional tech services powerhouse. Are we looking at the next phase of Singtel's evolution beyond traditional telecommunications? The company's revenue for the last fiscal year was 15.1 billion Singapore dollars, with net profit of 2.54 billion. Their debt-to-equity ratio stands at a manageable 0.48, giving them financial flexibility for these ambitious AI investments. The regional expansion strategy makes sense when you consider that Southeast Asia's digital economy is projected to reach $1 trillion by 2030. Another stock making headlines is Cordlife, operating in the specialized healthcare sector of cord blood banking. The company is still dealing with fallout from that November 2023 storage tank disaster that damaged thousands of cord blood units. Today's announcement offers enhanced support to affected customers, a 5-year extension to cord blood storage until children turn 26, at no extra cost. Cordlife shares closed 1.9% lower at 26 cents before this announcement. This comes after the stock has been absolutely hammered since the storage incident, falling over 30% when the news first broke. The company's market cap has shrunk to just 41.6 million Singapore dollars, down from over 60 million before the crisis. The question remains, can they recover from this reputational damage in such a trust-dependent business? The cord blood banking industry in Singapore is worth approximately 50 million Singapore dollars annually, with Cordlife holding about 60% market share. However, regulatory scrutiny has intensified, and the Health Sciences Authority has imposed stricter monitoring requirements. The company's revenue dropped 15% last quarter to 8.2 million Singapore dollars, primarily due to customer defections and reduced new signups. Let's talk about Q&M Dental Group, a key player in Singapore's healthcare services sector. They just issued 130 million Singapore dollars worth of notes at 3.95% interest, due in 28. These notes will list on SGX today, giving institutional and accredited investors a chance to participate in the company's growth story. The counter ended Thursday unchanged at 43 cents. What's interesting is they're using their 500 million Singapore dollar debt program established back in 2017. This shows they've been planning for expansion for years. The proceeds will fund acquisitions, business expansion, and working capital needs. With major banks like DBS, OCBC, and UOB as joint lead managers, this isn't a desperate cash grab. It's strategic growth financing. Q&M operates 130 dental outlets across Singapore, Malaysia, and China. Their revenue for the last fiscal year was 285 million Singapore dollars, up 12% from the previous year. The dental services market in Southeast Asia is growing at 8% annually, driven by rising healthcare awareness and disposable income. The company's return on equity stands at a healthy 18.5%, indicating efficient use of shareholder funds. Finally, we have PSC Corporation, where local tycoon Sam Goy, known as the Papaya King, is making his move. He's launched a mandatory offer at 40 cents per share to buy out the remaining shareholders after raising his stake to 43.38%. This represents a 7.8% premium over the 1-month volume-weighted average price of 37.1 cents. The stock fell 2.4% to close at 40 cents before the announcement, which is exactly his offer price. Goey spent 25.2 million Singapore dollars on 63 million shares to trigger this mandatory offer. If successful, the total buyout would cost around 123.5 million Singapore dollars. This is classic corporate maneuvering. He's been steadily accumulating shares for years and now wants full control of this fast-moving consumer goods business. PSC Corporation distributes over 3,000 product lines across Singapore, Malaysia, and other regional markets. Their annual revenue is approximately 580 million Singapore dollars, with net profit margins of around 3.2%. The FMCG distribution sector in Southeast Asia is consolidating, with larger players acquiring smaller competitors to achieve economies of scale. All right, let's pull all of today's movements together into my daily market take. What we've seen on the SGX today, particularly with the technology investment surge from Singtel and the corporate consolidation at PSC, really underscores a crucial point for us retail investors. The most crucial takeaway today, in my opinion, is the clear shift toward AI and technology transformation across traditional Singapore companies. Singtel's 130 million Singapore dollar AI bet isn't just about staying relevant. It's about positioning for the next decade of growth. This reminds us to always keep an eye on how established companies are reinventing themselves beyond their core business models. Today's movements also highlight the importance of crisis management and customer trust in specialized sectors like healthcare. Cordlife's ongoing struggles show how quickly things can unravel when operational standards slip. Meanwhile, Q&M Dental's successful debt issuance demonstrates how solid fundamentals and strategic planning can provide growth capital, even in challenging markets. The broader SGX market is showing resilience despite global uncertainties. Foreign institutional investors have been net buyers for 3 consecutive weeks, pumping in 450 million Singapore dollars. This suggests confidence in Singapore's economic fundamentals and the government's pro-business policies. Think about how your current holdings align with these broader trends. Are you positioned for the AI transformation? Do you understand the operational risks in your healthcare investments? And are you watching for consolidation opportunities in undervalued sectors? The Singapore economy is expected to grow 2.5 to 3.5% this year, supported by strong domestic consumption and recovering tourism. The Monetary Authority of Singapore has maintained a neutral policy stance, which is supportive for equity markets. Interest rates are expected to remain stable, making dividend-paying stocks like Singtel attractive for income investors. That's the scoop for the SGX today, July 11th, 2025. Navigating these daily market shifts is crucial for your wealth growth right here in Singapore. If you found this digest helpful and want to get my real-time analysis, urgent insights, and a daily heads up on crucial market movements delivered to you up to a week before anyone else sees them, then our premium membership is for you. It's just $1 a month, less than a cup of coffee. Think of it as your daily dose of market foresight directly from my desk. Ready to stay ahead in the Singapore market? Just click the link in the description below to become a member. Don't forget to like this video, share it with your fellow investors, and leave a comment below with your thoughts on today's market. I always read them.